welcome to the channel. This is your host, Paul, and today we're discussing the difference between stocks, ETFs, and mutual funds. So this video is geared towards the individual who may want to get involved in the stock market but may not know where to start. But don't worry, I got you. So, disclaimer, investing and trading has considerable risk. This information should be viewed as entertainment only, and please consult a licensed financial advisor for all investment needs. So, we all heard of stocks. This is probably why you're here. And let's get into what a stock is. So, they allow for partial ownership into one single company. You will need to acquire roughly 10% to have voting rights. So unless you're a big dog like Warren Buffett and have billions of dollars to throw around, the average Joe like you and I won't have to really worry about that. It is good to understand if the stock you're looking at is public or private. If it's public, you can download a brokerage account, you can fund it, you can search the company and add it to your account. If it's private, you may not have access to that unless you go through some sort of specialized investment company. So actually, let's look at how to look up a stock. So we'll head over to Google. Let's go to Yahoo Finance. And I'm going to search a couple companies by what's called their ticker symbol. So this is just a formation of letters to allow you to look up the company, or you can type in the whole name of the company and see will it pop up. So the first one I'm looking up is Apple. And as you can see, it costs $170 to buy one share of Apple. The next one I'm looking up is Microsoft. As you can see here, it costs $406 to buy one share of Microsoft. And we can look up one more. Everybody's favorite right now, Nvidia. It costs $875 to buy one single share of Nvidia. So back to the public versus private. A quick Google search will tell you if it's public or private. See, looking at Chick-fil-A, privately owned. But if I go in here and I type in Apple stock, it should come up. If it doesn't look like this, it's most likely privately owned. So next, let's talk about ETFs. ETFs are a grouping of stocks that follow an index or sector. You do not have ownership of the underlying assets. So what do I mean by that? ETF may hold portions of different stocks. Like for example, the SPY, the SPY, some of the top holdings are like Apple, Microsoft, Amazon, things of that nature. So as that, you don't actually own those. You just own the rights to the price fluctuation of the actual ETF itself. So ETFs can be passively or actively managed. Actively managed ETFs are going to have a higher expense ratio. So what I mean by that is you can own a passive ETF such as the SPY, and nobody's sitting there trading in and out of stuff on the daily. But if you go over to an actively managed fund like an ARK ETF, which we may look at here in a second, there's traders there. They're actively going in and out, making moves. It just costs more when people are working more. And ETF prices fluctuate throughout the day just like stocks. So what I like about stocks is that the managing company will adjust the underlying asset percent allocation based off of performance. So this happens more frequently in actively managed funds, where a passively managed fund may adjust on a quarterly or yearly basis. Nevertheless, you do not have to worry about selecting the best stocks yourself. So let's go look at a couple ETFs. Let's see, let's go to Yahoo Finance. Already mentioned the SPY. Here we go. So the SPY ETF tracks the S&P 500, and it costs $511 to get one share of this ETF, or one portion of this ETF. Another one, QQQ. QQQ tracks technology, and to get one share of this, it costs $439. And you can kind of see down here the expense ratio. So let's look at, and so this is a passively managed fund, so let's look at an actively managed. ARKK. This is a Kathy Wood fund. Her team, they go in and make trades quite often, and you see the expense ratio is a little higher here, where QQQ was 0.2 and this is 0.7. All right, let's talk about mutual funds. So mutual funds differ as it's an investment where your money is pooled together with other people in a portfolio that has specific investment objectives. And this can range wildly from dividends, growth, emerging markets, and things of that nature. Mutual funds are professionally managed, so they come with higher expense fees when compared to ETFs and even when compared to the actively managed ETFs, mutual funds may have higher expense ratios. But similar to ETFs, performance is based on the underlying assets that the fund holds. So same thing, you don't own the underlying assets themselves. And there's a couple different ways you can make money from these funds as well. Income. So the fund holder may pay you in the form of dividends. Distribution. If the fund sells off different assets and have excess cash, they may cut you a check. Capital gains. The overall value of the fund you invested in may go up, and so you get the appreciation from that. So when picking mutual funds, you must choose between a loaded and a non-loaded fund. A loaded fund has different fees, and a non-loaded fund does not have any fees. And so you may need to look at the growth that's associated with whichever one you may choose. All right, so let's compare all of these. With mutual funds, usually requires more upfront capital when buying in. Mutual funds pretty much are professionally managed, so that reduces the stress of searching for that perfect investment or perfect stock, which allows for diversification. ETFs require less capital, however, have lower expense ratios, which in turn is easier to trade in and out of. So when looking at mutual funds versus ETFs, the potential upside is lower, but also the potential same-day drawdown is lower, as each fund is constructed with a certain weighting of the underlying asset. And so what do I mean by that? So Tesla stock may move, make up a number, may move $10 to $15 in a single day. But the S&P 500 SPY may only move $5 $4 or $5 any single day. So your drawdown and or gains may be a little more muted when you're looking at an ETF, which if you have less of a risk tolerance, may be a good place to start. And so let's look at stocks. There's no additional fees for owning stocks, unless you're using a brokerage account that still charge commission fees, which most of them don't. And they allow for partial ownership of some of your favorite companies. However, you must be okay with seeing larger swings in your money as you're not diversified. So if you decide to be an individual stock picker, you want to be familiar with the increased risk involved. And so just kind of building on what I was talking about, you just want to be comfortable with how much the stock itself may move in a single day. So in conclusion, if you have a little bit of experience with stocks and have a higher risk tolerance, go ahead and pick your stocks. If you're brand new to investing, I'll recommend investing in ETFs. But once you kind of get comfortable with the ETFs, then I would have a few, probably 1 to 2 solid ETFs, and then slowly add shares, different stocks. I probably wouldn't go over 3 or 4, and probably altogether I probably have maybe 3 stocks, and then maybe 2 ETFs. You really don't want to log into your account and just have to scroll, because you want to be able to keep up with what's going on with all of these. So we reached the end of the video. And if you enjoyed the content, please leave a thumbs up and subscribe. Thank you.